But now coming to asset pricing, we all agree that understanding how prices of financial assets are set in the marketplace is important for all of us, because it transfers people who save to those who need the money, and clearly how much you save and what you expect to get and what risks you are taking are critical in how much you decide to save and where you decide to put it in those savings and how it gets to somebody else, and hopefully you'll get some of it back when you want it. And it's not an easy thing, because when you save today, the young people, when they save, they look at and see what happens to them in 20 years. And it's very difficult for you to understand what's going to happen to 20 years. Say, for example, if you invest in companies. I think if you look at, for example, the S&P 500 or all the stocks listed in the exchanges and ask how many of them will survive with the same structure, same name, and same tickers in 10 years' time, about half of them will not be there. So how do you decide what's the value of a security is when you invest in it? It's a very hard task, so I don't want to minimize the difficulties in valuation. So if a lot of people are taking a little peek at it and putting whatever they think is worth it, that whole trading process somehow aggregates all the information in a very interesting way that no one single person can do that. And that's what makes prices hopefully efficient and reflect information in a way that otherwise is not possible. So I'm a firm believer in market forces. And so, in spite of all the crises that you're seeing, I think a lot of the crisis that you see here today is not because of market-based problems, it's more because there's a lack of market and a lot of interventions and rules that entered in between, and it has unforeseen consequences. So with this, I'm going to continue. So I'm more going to talk about in terms of rational models of asset pricing. So let me take some numbers first. If you look at some numbers, historically, if you go from, Ken French has put down together created this very interesting data library. So it's very easily accessible. It's a fantastic service for everybody, including all the researchers. If you go from 1927 to 2012, stocks as a group, which I would call it as the market factor in the form of French, three-factor model. It has average, excess return of about 8%. If you look at the nominal risk-free rate, it's about 3.5%. Okay, so if you look at the real risk-free rate, it will be close to 0 or 1%. So the question you got to ask is that, why is this so high? So if from an investment perspective, if you're really savings for retirement, you would like to know, because whether you put at 8% premium over 3% or not, that makes a huge difference how much you can consume today, right? And so that really is one of the heart of some of the issues that we are looking at. So what kind of risk are you taking? Why is this persistent over many years? And if you look at value stocks, if you look at even smaller portfolios like value stocks and growth stocks, small value stocks earned about 18% more than small growth stocks on average. That's a huge premium. So if you ask why, you want to have some idea of why this happens, we start with some foundations. We start with an individual, let's say, we think about model. That's where the models come in. You want to abstract from a lot of things that obscure our vision and think about a hypothetical world and say, okay, let's think about that being some investor, and the investor lives for a very long time, and you say, these are the assets that are available to you, and how will you choose how much to save, how much to consume, and where to put your money in. And that is the basic paradigm of finance. And this person you can think of as being at the margin, setting prices without any transactions cost. And if you take this model, then you have to ask, how do you build this model? You have to ask, what is the objective of this model investor? So you have to endow the person with a utility function and an objective function that's maximize utility or lifetime utility. And then you can ask, what are all the markets you can invest in? And ask, what's going to happen here? So when you take a simple model like that, then you can make additional assumptions. That suppose that the first thing that falls out is that if this person is indifferent to making the right decisions, at the margin the person will be indifferent between moving money from one asset to another asset. So that we call the first order conditions. That sets some benchmark to say what will be the person's expectations. Given the person's expectations, what do you find from different assets, or what you expect to get? And that should be consistent with that person's optimization problem. And then you can ask, typically it will depend on the person's consumption. You don't observe individuals' consumption, they don't really live for a very long time. So you can say, okay, let's assume that everybody has, on average, have the same beliefs. And suppose they are all very much alike. Then what will happen? Then you can actually aggregate each person's, what they do in some loose sense, and then come up with some aggregate representative investor. And the representative investor will also look like a stand-in guy with very similar preferences that you started out with an individual. And then from there you can say a lot of things. Then if you make further, you can eliminate, because typically it will depend on how much I am consuming today, how much I am expecting to consume tomorrow, and how whatever I have a plan, how it will be feasible or infeasible, or how much pain will be inflicted because things don't go the right way, things like that. But therefore you have to know about the consumption plan of the investor. And that, you have two routes. You can then say that will determine your wealth today too, because how you consume, what you expect about the future, and all the consumption plans will tell you what the wealth is and how the wealth is evolving over time. So you can eliminate the consumption and express everything in terms of wealth, or you can eliminate the market returns and express everything in terms of consumption. And people have followed both the routes. So the classic example is a Sharpe-Lintner capital asset pricing model. So it tells you how to measure risk. It's only the systematic risk that matters and what systematic risk is. But the shortcoming of that is that it cannot explain what should be the risk premium on the market itself. It cannot tell you what the reasonable risk-free rate is. What it says is that given the risk-free rate is this, and this is the risk premium on one asset is, what should be the risk premium on some other asset is. Okay, so that it can answer. And when you look at the data, there are some issues with the model. Of course, it generated a long time back, so there are some issues. Then you can go to the track and say, I don't really care about everybody being at the margin, because I talked to Andrew and he said, I don't trade in these stocks and I only trade an index. And so people trade in limited things. So you have segmented markets, people don't trade on everything. Then you have to ask, if there is one guy and that person is at the margin and I don't observe the person's consumption, then I can make some other assumption. So I assume that there are only a few basic sources of risk in the economy, could be endogenous too, like I said. Then you can, with some additional assumptions about how the sources of risk, you can come up with some capital asset pricing model, standard CAPM type relation, which you call either linear factor models due to Steve Ross, or you can also look at Bob Merton's intertemporal asset pricing model. And most successful implementation of that is the Palma French 3-factor model, which is a great model. It seems to work. When you do those kinds of juggling around, you do seem to have a reasonable model that explains the cross-section of asset returns. And then you can think about finance people. Finance people are very clever. And when you think that you've solved some problem, they'll create more problems for you, because you come and say that, all these securities I can explain very well. And finance, the interesting thing about finance is that every person is big. You see, this assumption that you are tiny is not a great assumption, because once you can borrow and lend, you can become very big. You can manage a huge portfolio even though you start out with only $1 because you can borrow $1 zillion and lend it or invest that $1 zillion, assuming somebody believes enough in you to give you that, you can become very big. So, as usual, people will start looking at, can I form different types of portfolios? So instead of looking at basic primitive assets, because the original, interest in all this was looking at assets which were in positive net supply, because we all collectively have to hold them, right? Because if you think about it, you don't care about prices. Think about it. If you are like anybody else, what will you be holding? You will be holding the same thing like anybody else. And collectively, we are going to hold the market. So what will you be holding? You will only be investing in the market portfolio. The only difference, anything that is different from you and somebody else, because your situation is different from somebody else's situation, and what they face, their needs and what they maximize, all those things are very different. So you have to ask, in what way am I different from somebody else? Okay, so the original theme was to look at assets in positive net supply. Then came the derivative securities, and there was a branch of research that looked into derivative securities as purely redundant securities and said how you can, because the point is that people hold these assets in positive net supply. These assets are derivative. We can only tell you how to price it by trading and synthetically creating this from the available positive net supply securities. And that was the theme of Black-Scholes and others. Then once people started thinking about, like for example, momentum strategy, right? First it appeared in the literature, I think in 1967. This guy Levy, he wrote a paper, I think it came in the Journal of Finance. He did essentially the same thing later what they did, but in those days you didn't have access to the kind of computers and sorting and all that, so it was done in a much more primitive way. And then there's a huge gap, and then in 82, I think, right, 1990, late 80s, early 90s, Jagannathan Titman came with this momentum portfolio, how to construct it and how to look at it. It's a managed portfolio. If you look at it, it is not a primitive asset. It's a managed portfolio. That means you buy so-called winners and sell losers. And then it seems to make fantastic amount of returns. So if you look at the momentum portfolio return, you can go to Ken French's data library and download it, and you will see the so-called, form the portfolio over the last 11 months, skip a month and invest in it and hold for 1 month. That will be 1 year, 1 month strategy. It will give you, see the market Sharpe ratio, it's like 0.4. The Sharpe ratio for this is also about 0.5. It can be close to the market or maybe slightly, it depends on when you look at it. It's comparable, and when you combine the two, you can get a Sharpe ratio of almost 1. Okay, it tells you that if you want to consider managed portfolios, the managed portfolios have phenomenal returns and phenomenal Sharpe ratios. So you've got to really ask what's going on. So if it's not just a momentum portfolio, then you can look at carry trade, right? You can look at currencies that are if you look at countries with high interest rate and look at countries with low interest rate, then if you borrow at low interest rate and lend in the high interest rate, if the currency exchange rate doesn't change, you can go back and convert at the same rate, you have huge returns. So it must be the case that the currency with the high interest rate should be depreciating, at least with some probability crash, right? But you always think you can get out before the crash occurs because other people are slow, but you're very quick-footed, you can do that. In fact, I noticed it first time in Hong Kong. In fact, in mid-90s, Hong Kong, if you go to a bank, you can actually open what's called a multi-currency account. So I noticed that everybody in my class, I was teaching students, undergraduate kids, and you go to the shop guys have a little, handheld equipment, they can move money around. They're all moving money around, and where they were putting it in New Zealand dollars or Australian dollars. And so it is not like it's only be done by, big time arbitrageurs or hedge fund. They're done at very small people in small amounts of money. So the managed portfolios seem to also produce very high Sharpe ratios. It can get you a Sharpe ratio of about 1. It's actually huge. But again, think about, for example, what are the other things, then momentum, like Active Fastness recently showed, there is momentum in almost across countries, across country indices, across commodities, and a whole bunch of things. So these patterns, now that we can look at the computer and look at things much more easily, all these things are striking you in the face. But you have to first ask, if I go along the momentum strategy, who's doing the short side, right? So somebody must be on the other side, and who is that somebody? And that is a big puzzle. People are trying to answer that. Then you have the so-called behavioral finance, people coming and saying that, people, what they are, that beliefs and how they make sense out of what they see, it depends on what they did, and it depends on the individual, and have all these biases, and that's what is showing up. And so the guys who are very smart, like our MPA students, they are by taking the momentum long, and the guys on the other side are these people who are subject to a lot of biases in making decisions. And once you go that route, then you have to ask, how much can you do these things before the other side wakes up? Because if you make small mistakes, you wake up. But if you make big mistakes that you can realize that you made a big mistake, it's very difficult to believe that all those behavioral biases will hold on for that long, right? Because when you talk to some people, they say, why do you trade? I had a friend who said that, I spend about $5,000 I lose every year. I'm one of your behavioral guys, I lose all that. And I said, okay, what's your profession? The guy is a doctor. And he said, why do you do all this? He said, you know what, Ravi, I don't have any friends. So I like to go and talk every week to people as to what I'm doing. It's much more fun when I'm, periodically trading and losing money. When I talk to people, they like what I'm doing. So I have a lot of friends. So, and then he says, if I make a lot of money, what happens? He says, last year I made $20,000. What did you do? I took my friends to Las Vegas and blew it all up. So it's even better friends. So at some level, the reason I'm pointing out is that there's a lot of things that you see. At some level, you have to ask, is it really going to explain a lot of things? So this managed portfolios, coming back to it, then I ask myself, is it because it's just a small thing? The moment you start doing more of it, it will vanish. It's like these guys are doing for fun, and they don't mind losing $5,000. Okay, because instead of taking a vacation in the Cayman Islands, they want to go to Las Vegas with their buddies. Not only that, they can also talk to them every week. Okay, it makes them very happy. So to answer that question, you're going to look at how much money is being managed using some of these strategies. And when you look at that, it is actually quite large. It is not small. So it comes into a significant amount. If you look at active portfolio managers, that's about maybe a third of the total money that's being managed in some form, some active form, some tilting, and those guys use some kind of momentum at some level, not completely, at some level. And when you look at that, that means there's something else going on. So you have to take a step back and say, when you think equity premium is a big puzzle, and you're trying to understand why people are comfortable, holding treasuries, yielding so low, and also stocks which yield so high, that's because you want to think about risk in a particular way. And look at this. Here, the people who are going to do this is not you and me, because there's a lot of trading involved. And to do executions right and keep watching things, we all have a job to do. So we're not going to do that. It's done by professional money managers. And then, if it's the intermediaries which are doing all this for you, then you have to ask yourself, what's the incentive of these intermediaries? So I started out with the representative agent model, and I thought that maybe I can assume away all these intermediaries and say, you know what, this is what they want to do. If there are intermediaries do exactly what my investor wants to do. So the difference between the intermediary and the individual being different, I can ignore that. So it dawned on me when I was trying to explain this to my son that he said that, Dad, this doesn't look good, because if you're not watching, they're going to run away with the money. And I said, yes, that's one of the biggest problem here. So the agency issues become first order. So if agency issues are first order with intermediaries, And if I don't know how to evaluate what they're doing, then intermediaries cannot get that much money, right? That's the Vishnish life story, that the intermediaries themselves have to depend on your money, so they cannot eliminate whatever looks like mispricing in the market. So they're going to persist for a while. And then, how do I explain what's the, our prices are right or wrong and something else is going on? So that means that, suppose I think that intermediaries are the ones who are always at the margin, at least for certain kinds of explaining why certain kinds of managed portfolio strategies earn such high returns, then I have to understand how intermediaries work. So we can think about intermediaries being at the margin, endow them with some, make some assumptions about how they behave, what their objectives are, and then maybe some of these portfolios that earn such high returns are a puzzle. If I only look at this representative agent, can I do something better? Interestingly, some of the recent work has taken that tack, and they find that if you think about an intermediary, and the question is, how do you measure the intermediaries, how they trade off, what portfolios they have to hold, then there is strikingly surprising support that they can actually explain many of the cross-sectional differences in returns across a lot of these managed portfolios. Okay, Tyler Muir, who was in the job market, he's gone to Yale. Yeah, he did some other work, and his co-authors was Adrian, Tobias Adrian at Fed, and another person, and it originated with some work by Zigua Hay and Arvind Krishnamurthy and my colleague, and Zigua is at Chicago Booth School. And so that's about where it went. Then on the other side, you have to ask, all these things are relative pricing. Then you have to ask, can you say something about what's happening in the economy, and ask what's a reasonable risk premium, right? Not saying that if this asset has a risk premium so much, what will be the risk premium on some other assets? I want to ask, is 8% a reasonable number for equities? Or is the risk-free rate being close to such low number, is that reasonable? And why does it vary over time? For example, Jules von Winsbergen, who was my colleague at Kellogg a while back, he and Ralph and others, they wrote a very interesting paper pointing out that if you look at the term structure of expected returns on equities, that you have to get into the details of how they did that. They used some futures market data and all that. There are some issues with the earlier work they did with options because they're illiquid, but the futures market confirms that it's actually more liquid assets. Yeah, when times are really, really bad, like when you hit a financial crisis, we hit only 2 of them recently, is you find that the equity risk premium goes up, but the spiking is only for the immediate future. So thereafter, it's very much like what it should be. Like if you think about the term structure of interest rates, typically it is upward sloping. Sometimes it can be downward sloping or flat, but it'll asymptote out to something later. So after some time, it gets to be flat, right? That's the idea. But he finds that in equities too, similar pattern. Most of the time it's upward sloping, but sometimes it can be humped. That is, it can come down, and then it can be downward sloping for the immediate thing. It can be very high in the short run. If that happens, the question is, all the models people built, like habit and recursive preferences and a variety of other things, it has difficulty explaining why this happens. So then if you look at the same time, there's another development that is taking place, which is this volatility risk premium. Those who look at volatilities, some volatility shocks are short-lived. That is, some risks get resolved earlier, some risks take a long time to get resolved. So if you look at volatilities, they have a lot of frequencies. It occurs at a lot of different frequencies. And if some shocks occur and die out faster and some take a much longer time, once you enrich the type of risk that happens in the economy to that kind of multiple frequencies, then you can actually explain why you may get downward sloping and sometimes mostly upward sloping, but sometimes downward sloping term structure of equity premium with the kind of preferences people have been working on. Okay, to summarize, the way I would put it is that if with finance developing, managed portfolios have become important. And managed portfolios, they exhibit very interesting return patterns. And to explain that will be one of the challenges of the future. And that, to me, points that we have to understand financial intermediaries and what they do and what their objectives are. And in doing so, we will understand why certain assets look and behave the way they do in the data, and answer the question as to whether they will behave the same way in the future, and how much money you can actually put in those things, and what kind of incentive system you have to set up if you have to trust the intermediaries with your money. And those, I think, are open issues, and with that, I think I'll stop.
Very good. Any questions that you might want to raise? I have a question. So one of the things that you talked about is trying to find the marginal investor. Right? And how would you go about, suppose I want to write a dissertation on finding the marginal investor. So challenge you, how would I go about it?
Okay, there are a couple of papers which are related. I won't say, because if I know how to do something better, I would have done it. So I don't know. I can only look at the past. I'll put it. One is this paper by Toby Markovich and Annette Wissing-Jorgensen. They look at, which was also like what some of the other people looked at, is that not everybody, if you look at around people, not everybody is investing in stocks, right? If I ask you, how much do you hold in stocks? Probably not very much, except what you index and do that. So you can think about relatively wealthier part of the population and ask, what do they do? How does that consumption behave? And subject to data limitation, you can look at some type of data like that. And they found, as a Journal of Finance paper, they find a stronger support. Okay, along some, you have to define what stronger means. Stronger support for this type of modeling approach, that there is somebody sitting there with some rational beliefs, reasonably rational beliefs, investing in these securities. That's one. Second, Tyler did a very interesting exercise, and I still remember this because he wrote this when he was a second-year student at Kellogg, because they saw the paper by Zigua, and Arvind Krishnamurthy is very stylish. It's a very stylized model. So he came up with this nice insight that if you think about firms, let me ask you that. If I tell you a firm, if you look at 10 firms and you find that one of them is much highly levered and one of them is not as highly levered, they all started out with the same leverage 2 years back, what would be your conclusion? One of them did very poorly, so the stock price dropped. So the value of debt relative to the total market value went up, so it's highly levered. So if the firm did very well, its leverage will go down, right? Unless the firm does something to change it. So past performance will affect the current leverage. Okay, on average, that's what you should find. And what do you think about going forward? The future looks great or not so great. Typically, firms which don't do very well could be because maybe they are in the bad industry or they're competing with somebody better. So it's not going to improve, right? At least the real performance will show a lot of persistence. Whereas if you now think about, therefore when leverage goes up, the future real performance of the firm is likely to go down, right? Because if you are facing BlackBerry, facing competition with somebody or Nokia, you went down because the competition come up with some product that sort of made it more attractive to the consumer. So you may break through again, but it's not like it's going to be the same day as before. So there's a lot of persistence on the real side, the way that things are. But if you think about a financial intermediary, and what's a financial intermediary, like Goldman or any of these investment banks and all these guys, what do? A bunch of people like us sitting there with the computer, right, and have a list of people whom to contact, and everything is just record keeping, and everything is just their ideas, that's all. So if you look at the pay, most of the money that the firm makes, a huge part of it is shared with people like you who are sitting there and call yourself the bank, right? It's really a relationship network. That's what it is, right? And knowledge, and it's nothing else. And so if you ask yourself, I find that your leverage has gone up, what does it mean? Did you do badly in the past? When will you lever up? Suppose you are a trader, when will you lever up a lot? you think the future is looking good, right? Because you find a great opportunity. Suppose you have perfect arbitrage opportunity that then you will borrow and lend and take or invest and take the opportunity and make money for yourself. So how do those financial intermediaries function? They will increase leverage if things look great tomorrow, right? It's not how you look back. The leverage of financial intermediaries, unlike most manufacturing and other sectors, means that when your leverage goes up, your future looks good, right? So suppose I'm a financial intermediary, I'm at the margin, right? What does risk mean? Risk means that if I get a payoff in good times, it's not worth as much as when I get a payoff tomorrow in a bad time because then I really need the money, right? So if the guy at the margin is the financial intermediary, tomorrow I find that his leverage goes up, what does it mean? Times are good or bad? He's taking a bet about even further out future, but his wealth has gone up. When he takes up a higher, or she takes up higher leverage, it means on average the future is better, but the future money, when you discount it and their expectations are rational, means the wealth has gone up. So when the leverage of the financial intermediary goes up tomorrow, that is a good time, not a bad time. Similarly, when it goes down, that means the opportunities are dried up, the guy is trying to go home and sleep and wait for better opportunities and maybe read some books. So, right, that's what you do. And so that means it's bad times. So it goes the other way with financial intermediary. So when you look at therefore the growth rate and leverage of the financial intermediary and how it co-moves with these asset returns, that is a good measure of systematic risk. That's a very neat insight that Tyler came up with, and Tobias Adrian and his other co-author are working from a slightly different interpretation of why that may work. That's also valid. It's not like so. They combine the papers because I think Journal of Finance editor asked them to combine the papers, and they have one published paper. But that was a very neat insight, as Viral was saying. People come up with great papers not because we tell them what is great research. It has to come from you and your belly. You have to be fired up. You have to come up with your own ideas. Ask me what's the great research. I can tell you after it happens. How do you get there? I have no idea. Okay? So with that, I will stop.
Very good.